The European Central Bank has cut interest rates by 25 base points to a new record low of 0.75% and has said that it won't pay anything on overnight deposits as the central bank looks to stem the European debt crisis. Marie Diron, Senior Economic Advisor at Ernst Young, is on the phone with me now, direct from London, to talk us through these changes. Marie, the ECB has made the cuts anticipated by the markets. Some had hoped that the ECB President Mario Draghi would take a harder line. What are your personal thoughts on this action?
Yes, we were also hoping or expecting that maybe they would cut by 50 basis points as a stronger signal that they are indeed using all the tools at their disposal to help the economy in these quite challenging times. I suspect the more moderate cut probably reflects some concerns within the ECB Governing Council that with the deposit rate at zero, some banks might suffer on their profitability. We would argue that these are lesser concerns at the moment, and that bringing rates to as low levels as possible would have been more helpful.
Draghi let slip that some members of the Governing Council had voted in favour of a cut last month. Is this move now a sign that the ECB really has hit the panic button?
I don't think they're really panicking. I think the fact that the cut is of relatively small size, and we don't expect any further announcements in either extra liquidity being provided or significant loosening of the collateral list that can be brought at the ECB's liquidity operations. So I don't see really this rate cut as a panic move. On the contrary, I see it as a very kind of controlled easing of monetary policy and a signal that the ECB is aware of the downside risks that the economy faces.
Economists have suggested that the lower the ECB rates go, the more they may have to consider using asset purchases to ease policy. Is asset purchasing and QE likely to become the new focus for the ECB?
Well, it is. They're getting very close to zero, which is really probably the absolute limit. So, and there's decreasing return on cutting rates. So, indeed, they might need to consider other policies, including outright quantitative easing. I don't think they're there yet. I think they will need to see really an escalation of this crisis before considering this kind of policies.
China leapt on the interest rate bandwagon also today, making a surprise second cut in as many months following the Bank of England's rate decision. Robert Gray told Dukascopy TV earlier today that he feels that had the BOE known about China's cut, they may have acted differently. Can the same be said for the ECB?
I'm not sure. The China's rate cut really reflects the slowdown in the Chinese economy, which, if anything, might raise concerns of the ECB that the one sector that is still growing, which is the export sector, might turn weaker in the next few quarters. So, if anything, maybe the fact that the Chinese authorities are apparently worried about their own economy would raise concerns in Europe too.
Traders have been employing a wait-and-see stance today ahead of today's announcement. As such, European stocks showed little movement and the euro had shifted little against the dollar. We've already seen both the euro and stocks take a nosedive following this announcement. What movements can we expect?
I think the market movement really in the next few days and weeks will be driven not only by this decision, but also by any announcements by governments, any signs about further progress from the June meeting at the end of the month towards medium-term reforms. So there's a lot of measures being discussed, banking union being probably at the forefront of the agenda, and that will probably drive market movements in the next few weeks.
In terms of the broader Eurozone picture, Italy are refusing a bailout, with Mario Monti stating that its public finances will improve, while Slovenia looks set to become the sixth Eurozone country to request an EU bailout. While this cut is positive for the markets, it shows a dire economic scenario really, doesn't it?
Yes, the Eurozone is still facing a very difficult year. We expect a small contraction in the year as a whole, with probably a negative second quarter, maybe even a negative third quarter. So there's still really a lot of headwinds to deal with. Fiscal austerity is biting unemployment is rising and hitting households' incomes. Credit conditions in general are quite tight, and that means that domestic demand in general will probably contract further before it can recover.
This story looks set to continue, but unfortunately that's all we've got time for right now. Marie, thank you for your comments. The Dukascopy TV team will keep you updated on this story and more. Goodbye for now.